Good morning, everybody. Welcome to the Flow Show. I don't even know what day it is. What is it? Thursday, 17th of October. Just me today. Mr. K-Man is off house hunting, and might be a bit of a quick show because I'm not feeling the best today. My good wife came down with the old COVID lurgy this week, and she's kindly shared it with me, it seems. So I'm on the cusp of that one. So if you do find that the show is paused now and again, it's probably because I'm coughing, sneezing, blowing my nose, or I'm just decided to lie down on the floor. So anyway, let's crack on while I can get through it. Start off in China. PBOC has promised more loans for tech firms. We had this meeting as well between various ministries, housing ministries, PBOC, MOF. The Deputy Governor commenting on mortgage rate cuts. They will be applied to 90% of existing mortgages on the 25th of October. They will also be lowering the minimum down payment ratios, and they have already observed market confidence and sales as a result of the prime moves there. Says on residential development loans will be extended until the end of 2026. These are part of the programs that they've already been running. So as I've been saying, they've already been putting a lot of stimulus into this. So these latest measures over the last couple of weeks isn't just the start, it's a continuation. It says on existing mortgage rate cuts, they say that rates will fall by an average of 0.5 percentage point, which will benefit 50 million households and 150 million residents. The housing minister says it's going to aim to renovate 1 million houses in urban villages. So that will get you some GDP growth and activity when they put people to work. That's the thing you can't rule out with China. They can put people to work, and that activity comes under GDP. We're still in a situation where the market is seemingly underwhelmed about what China is doing as far as support measures. But the question you've got to ask yourself is who you're going to put your money on. Are you going to put on the market being right that these measures are underwhelming, or are you going to put your money on China and the PBOC, who have the tools and the means to make this work? So I think that's the game we're going to be playing at the moment. But as I previously mentioned as well, they've got to fix the international relations side of things, or this is all just going to be domestically led. And we know they're a big export country, so they need to get that side going as well. Moving on to Japan, and the head of the Japanese Bankers Association, he thinks that the Japanese economy is really at a tipping point with wage increases. Don't know which way he means it's going to tip, either continue to the positive or continue to the negative. But I don't know the context of those comments, but it's probably tipping to the positive because they've never had this level of wage gains and pressure to raise wages for many years. There might be some trouble brewing for this election in Japan, according to a poll run by the Nikkei. Ishiba's LDP party is at risk of losing their majority in the lower house. They're saying they may not reach the 233 seats it needs for an outright majority. There's 465 seats. There is chatter that if that is the case, they might do another coalition deal with their upper house coalition parties, Komeito. But also the third largest party, the Japan Innovation Party, hasn't ruled out going into coalition 2. So the LDP are the far largest party, been in control for some time, but they are held up in the upper house by a coalition. If they are forced to go into a coalition in the lower house as well, that's just further cracks appearing in their leadership. Much like everything else in Japan, it's a slow process, but they've gone from overly dominant to coalition dominant. Next stop might be a change altogether. There's been a GG poll rating the new government that's coming in at a 28% satisfaction level, which is the lowest for a new government since the 2000s. So he's got a lot of work to do. So it's not all going positive for the LDP. Probably something we need to just keep an eye on for the future. Over in Down Underland, we had jobs data from the Aussies and a fairly decent set of numbers as well. 64k was the employment change and expected to rise 25k. The bulk of that going into full-time employment. So that's good news as well. The unemployment rate came down to 4.1%, which is good news because it's expected to rise to 4.2%. That's good news as well. Well, staying unchanged is good news because the participation rate went up a point, 67.2%. So wouldn't have been a surprise if that unemployment rate came in at that 4.2. So coming in at 4.1, that's looking okay. So decent numbers there from Australia. Over in the Eurozone, we had the final CPI numbers ahead of the ECB. Nothing really of note. The headline did come in a pip softer, so that's a 5 pip pullback over last month, 2.2 there. The core came in as per the flash 2.7 and down a pip on last month's 2.8%. I don't think it really changed anything for today's ECB meeting, but just that slightly softer number may have get a few more questions raised about what they're going to do after today and whether this is going to be a fast series of cuts coming. Yesterday's NBA mortgage rate took another jump, again reflecting this less dovish stance that we're getting at the moment, 6.52%, quite a steep drop in mortgage applications. So as mortgage rates are rising, it could be putting the brakes on a little bit into the housing market, but we shall keep an eye on that one. We had US import and export prices in there, a lot of minuses on those numbers. So it's picking up a bit there on the negative numbers, which in part feeds through into PPI, CPI and the like. So we've gone from a year or so ago where we're seeing a lot of positive numbers to now seeing a lot of negative numbers. Goldies, they've got their latest seaweed out from the shed to have a look and forecast what the Fed and ECB are going to do. They expect the Fed to now deliver consecutive 25 pip cuts from November through to June 2025, which will take them to a terminal rate of 3.25 to 3.5%. They also expect the ECB to go 25 today and then sequential 25 cuts until the policy rate reaches 2% in June 2025. So that's their latest call. Keep an eye on that. If you're wondering why stocks are looking pretty bullish this morning, partly reason is the TSMC Q3 earnings coming at a whopping beat. Really blew the doors off this one. Revenues 325 billion versus 299 billion expected. Revenues were up 36% year on year. They see Q4 sales 26 to 27 billion. The estimations were for just shy of 25 billion. So tech companies, biggest in the world, or one of the biggest chip makers in the world, blowing the doors off. And that's why we've seen stocks, futures at least, and the performance in European stocks booming this morning as well. Geopolitics, Norway's getting into a bum fight with Russia. Russia is now going to retaliate against Norway in a painful way over the decision to cut Russian diplomatic staff. So the Norwegian government has said Russia's got to get some staff out of their embassies, which Russia hasn't taken kindly to. So they're looking to respond to that. US officials are still trying to work out when Israel is going to retaliate to Iran's retaliation. Apparently there's been note that Israel has decided what it wants to do, or very close to deciding what it wants to do, and US officials expect Israel to counterattack before the US election day. So we still got obviously a few days to go before that, a couple of weeks. So we don't know when it's going to come, but it's still on the table, and we need to keep an eye on that one as well. Lots of stuff we need to keep an eye on. We need a few eyes. I only got two. Need to be a spider. Right, ECB day. So we'll have a look at that. All the expectations are for a cut of 25 pips. That's on the main rate, which got yanked down by 60 pips last time, just to bring it more in line with the deposit rate, but expected 25 pips there. Deposit rate 25 pips as well. So really, it's not about what the rate move is. There is maybe some small risk that they go a 50. I think that would shock the market, and I don't think the ECB's in the zone to shock the market at this stage, because that would insinuate they're worried about something more than everyone else is. So that will really crater the euro. And I don't think they want to do that. But this is the age we're in at the moment, where 50s seem to be the norm these days. So you can never rule it out from anyone at the moment. So anyway, if they go 25, then the focus is going to be on what they do next. Is it a 25 and hold? Maybe into the new year? Are they going to signal a follow-up cut, series of cuts? Who knows? That's going to be which way the market is leaning, to see if they're going to be more dovish than they have been. Obviously, if they're not, if they're sticking to the same line, yeah, we're going to continue cutting as the data suggests, or when the data tells us to. Then that's going to see the euro rising, probably, because the market's going to take that as undovish, more so than it is dovish. So that's the slant we've got going in here. Now, you've got to be careful today, because we've got the announcement at 1:15 UK time. Then we've got jobless claims and retail sales, and to chuck a bit more spice in, we've got the Philly Fed manufacturing stuff. So there's a lot of US data coming in between the announcement and Lagarde's presser. Jobless claims is obviously going to be watched very closely after last week's numbers, but they were weather affected, so we're likely to see that potentially continuing. This weather stuff is probably going to be in these numbers for maybe another 2, 3, 4 weeks, because it's not just a 1 week thing. Okay, hurricane happened over the course of a few days, and now it's all over and done with. There's still people who haven't got homes. There's still people out going to be out of work for an extended period while they sort themselves out. So expect the fallout from this weather stuff to be reflected in this data, perhaps, as I say, for 2, 3, 4 more readings. Before then, maybe it settles down. So the market knows that there's a weather impact here, so it's not going to be too surprised if we get some funky numbers. If we get another 250, a 270, even a 300, it will look bad on the face of it, but take the weather into account. The market will be looking through that and seeing what happens once things are settled down. Retail sales, obviously, that's going to be important to see how the US consumer is going on. Any big negatives there, and then we'll probably switch to from pricing some unchanged forecasts or expectations, going back to pricing 25s and maybe slide into a 50 again if it's a big negative. On the other side, if we see some strong positive numbers from retail sales, then we're going to see a bit of a pendulum swing from a 25 cut to unchanged expectations. So that's where we are at the moment. And as I said, the Philly Fed, just it's a regional number, but just might add or subtract from that data. Right, let's have a look at what's going on. So there's stocks, and you can see that TSMC news coming out this morning and leading to all this. So we're back up towards these all-time highs up here. Can we get through? Probably a good chance we do. Once the Yanks come in and see those numbers, we might get a bit of a follow-through, because once again, it's looking like everything's tickety-boo in equities land. No firms waving any big red flags. So it's business as usual. No reason to see stocks dipping at all. Going to have a look at euro dollar, because obviously that's going to be important today with the ECB. So we got down to my zone. We started holding into it, then we broke it. Now we're holding below it. So we're swimming in the blue sea at the moment. This one's really going to be a case of what happens over the ECB. Do we finish the ECB above it, or have we cracked below it? If we've cracked below it and we start holding below it, then there's every reason why we're going to be knocking to the downside. We've knocked out all these fibs now, 61.8 of the August. So, you know, this is really a last line in the sand for these trends. We've already knocked out this leg of the trend. Now we're knocking out this leg of the trend. So if that happens, if we're under there, if we're under 108.30, when all said and done after the ECB, then we maybe need to be thinking about some lower levels, the 107s, maybe even a bit further. Obviously, the US data, if it keeps coming in strong as it is, then that's going to put more pressure on the euro. And particularly if they set up faster cuts, more cuts, we could be going all the way back to 107. Maybe even start thinking about another move back down to the 105s. So obviously a long way away, but you know, what's happening here at the moment will give us a signal as to whether that's a possibility, and then we'll see what happens with that one. Conversely, if it's not as dovish from the ECB and we see a rally in the euro, needs to knock out some of these levels. Obviously the 109, 109.10 level is the closest, and then 109.30s, 40s, 109.60s, 70s up there. So it's got a lot of work to do if it's going to bounce. I'll probably say on balance, if I had to pick a side, if the market takes the ECB as undovish, we're going to see a bounce, but I think that bounce will get sold into. I don't think the market's given up this bone just yet in terms of what the US is doing on the US side. Jacob, after the inflation report, do you still see the fastest cuts? My view is not so much the speed of cuts, although that will be important. My view is whether inflation continues on going lower. That'll be the case. My thing for going into the end of this year, next year, is whether central banks, particularly the ECB, are going to be forced to chase inflation lower. We know they like to react too late. We're now below the ECB's target. Some countries quite significantly below. They're expecting an inflation bounce into the end of the year. Well, really, they've only got 2 more readings now, or 3 more readings now. If that doesn't happen, if inflation keeps going down, then the market is going to get very, very bearish and very dovish over the ECB. And then we'll get all the talk that they're expecting to get. Rates will be going back to 0 and all that sort of palaver. So as always, the market will get far extreme dovish if inflation does keep going down. That's your case for seeing the euro heading all the way back down to 107s or even more if that happens. So this inflation report today, no, I don't think it changed anything because it's the final number. Most of the damage has already been done, but yeah, it's what is going to happen next. Parity. Yeah, we'll get the parity calls once again, and they might be right. It'll be 2 out of 3 that they'll be right on this one. So anyway, yeah, that's it for the euro. Gold, I'm keeping a close eye on as well. It's feeling like it wants to have a break up. Just looking at the price action. I said yesterday we had a fail here. I said if it got and held under 26.70, then we'll probably see a steeper pullback. Well, it knocked 4 pips under that level. Didn't last, didn't hold, bounced back up, and now we've been up testing these highs again. It's just, as I say, this is just a bit feeling like it wants to have a go, a bit like this sort of action here. You've had the highs, had a retest, and then it's building up a bit of steam, and maybe you have a blow through. What it does, on the blow through is anyone's guess. Does it just knock a couple of ticks above and then reverses, or does it go on and have a break up to 2700? I don't know. I'm running a little buy stop above, just a small trade, tight one, just to see if I can add a bit back into my position that I've been slicing from down here, 2620s. But as I say, I'm just getting the feeling that it wants to have a look through those highs. But if it doesn't, if we don't get through there, that would set up the potential for a steeper pullback. And if it gets below that level, yesterday's low point there, then maybe we're going back into the neutral zone, 2640s, 50s. What else? Keep an eye on China, and Chinese stocks didn't have the greatest of days. It's been pretty much one-way traffic all the way down since those highs. So the lower we go in this, then expect maybe some further support to come in from financials, the PBOC picking up a phone here and there and saying, excuse me, the stocks are getting a bit too low. You need to get in and start buying. If you get that, then you're going to see maybe a bit of a move in risk as well. Copper is the other China asset that I like to keep an eye on for this. And also, it's just continuing to bleed lower from those highs there. All this hopium trade has washed out. The yuan as well, I'll find it. Where's it gone? That's been weakening as well. Likely, as I say, we've had the hopium trade, and now it's all washing out a bit. And now it's got to produce results. And this is a bit of disappointment over all these measures. Again, the market, I think, maybe getting too underwhelmed for what China's actually doing. But there's also a little bit of dollar in here as well, where we're seeing dollar strength around the grounds. Dollar yen, that's again having a little struggle into this 150 level, showing that it is a bit of a tough nut up here. This data this afternoon, if it's strong data, then we're probably going to go through that in a blink, and then we're heading up to the 50 fib of this move down at 150.76, which is a bit of an area all on its own as well. So I like it when levels match with the tech confluence as well, like the fibs. So that was a level all on its own around this, higher 150s into 151. So that would be the next potential destination. Still high volatility in this one, so you've got to be careful with that. Yields as well through this US data, keep an eye on that. We haven't looked like we've been trying to get up back to these highs, but we're not out the woods. We're not pulling back too sharply. Again, strong data today. It'll be interesting to see what it does. If we get up above 4% in twos, I'll be looking around that 4.3 area. That was a bit of a spike move, so the real level is probably about 4.3. If we get up there, but can't get higher, can't go on to test these highs, I'll push through that. That would again suggest that yields are maybe topping out at this level, which is something I was looking for all through this move, where it would top out. Again, if that happens, it's going to limit the dollar in certain pairs, particularly dollar yen. Okay, so you can match it all up. 10 years as well, and a pretty swift move down to the 4% mark, knocked under it, but it's held there, and we're seeing it push back up again. The level's probably around this 412 area. Forget the moving averages. I don't do moving averages on yield, but I can't be bothered to switch them off. Right, let's have a look, see what you guys and girls are up to. Ali's got a big one. Out of the box question. We know dollar yen's going higher. There are buyers and sellers in dollar yen. Why most professionals don't go against this big trend? Market is rejecting the fourth time in the row at 150. If we've been short against 150, we could have been making 40 to 60 pips. Why is there psychology of not short big levels most of the times? I don't know. I love shorting big figures, Ali. I love shorting big figures where we've been away from them for a long time. I didn't do this one. I think what happens is, that, for me, the psychology plays a point. If I don't hit the first move, I'm going to be less keen to do the second and third moves, because what that's saying is that we keep coming back to a level. Okay, someone's obviously sold it here because it didn't go higher. So either there's barriers in play that someone's protecting, or someone's got orders up there. It could be any number of reasons why we hit a level and don't go through. Doesn't have to be speculative. Okay, it could be businesses have got orders to trade at that level for part of their business, be it invoices, be it repatriation of profits, whatever the situation. It doesn't always mean that these moves are speculative. Okay, you have to factor that in. But trading big figures is something I like to do. 107 in euro dollar. That's something I'll have a look at if we get there. 152 in dollar yen is a level I look at because it's got prior history. So there's all ways to trade these big figures, and the big figures do often support and resist on a first attempt when you haven't been there. So forget about what the big boys are doing. Forget about the professionals. Doesn't matter what they're doing because you don't know what they're doing, and if you do know, then you can front run them or trade with them. All you have to worry about is what are you going to do at those levels. If you like a level, trade it. If it ticks all of your boxes, trade it. Don't worry about what anyone else is doing. Just understand why you want to trade it. Take the sentiment into account, take the trends into account, and you trade it accordingly. But there's no difference to trading any other level, whether you're trading a fib, a moving average, or whatever. If you like a level, trade it and manage it, and forget about what the big boys are doing. Let's have a look. What else are you up to? You're also planning to go long in gold. Yeah, I wouldn't like the break up in gold to come over the data because, again, I've been in that situation. I've warned about that situation where you get break moves over data points. It's just a reaction, and then the market can reverse on that. So if I've still got a buy stop running closer to the data and we're not triggered and we're trading, a couple of pips below that 85 level in gold, then I'm probably going to pull my order because I don't want to get flipped out just trading a quick break, particularly if that break doesn't give me any opportunity to take some profit on that. If we get a break here and it runs to 90, 95, and then in seconds it's back down below there, then that's not a trade I want to be part of. So if you want to trade gold and you want to trade a break on the data, then if you get a move up, look for a confirmation hold. So if we do break above 85, it needs to stay above 85. If it does that, that's potentially your indication then to try a long trade from that. But otherwise, maybe just wait for another dip back and try your luck there. Aussie dollar had a little pokey above the figure on that jobs data from Australia. Got up to close to 67.10. That was it. And now we're back down below. So this 67 level is still proving key. We're back into the zone here as well. We did get through it, but couldn't hold below it for any real length of time. If we get a secondary move now below this level, then I will be expecting it to maybe start finding resistance there, and then we push lower. But we do have some decent levels just down below the 50 fib, 66.45. It's been an old traffic area. Again, another level that's been a level irrespective of the fib. So this is a level you've got to respect. It's quite a decent level. So even if we do break under this zone, know where your traffic zone is your problem. If you're short in this one here, these are the levels you want to be thinking about, maybe taking some profit in case they hold and we don't and we bounce from there. Am I ready to try longs though? Not really, not right now. But this level, if it comes over the data, if it's strong US data and we tap it, don't go through it, then maybe I'll give it a little go for a bit of a scalp. But depends on what else I'm looking at as well. I'm still in my Aussie Kiwi, which is just stepping down a bit. I haven't added anything back in. Every time we've got back up to the 50s, I thought about adding a bit of what I cut when I first traded it, and we had this move here. But it's quite willing to bounce back. It's willing to be sold and it's willing to be bought as well. So this one's a bit indecision. Okay, it was fairly tight, but as you can see, the range is just widening up here at the moment. So we're getting a bit of volatility in that. Don't know. I may add up if I see it above here again, and just maybe start being a bit more dynamic, offloading in the dips and getting back in the rallies. You're still short dollar Kiwi. That's good stuff, mate. Let's have a quick look at dollar Kiwi. This is looking a bit like the Aussie dollar was before it had its mooch down. Finding plenty of support on a level, but not yet ready to break it. But it is looking very similar because it's got the same type of pattern here where the bounces are pretty weak and they're getting pretty weaker. So you've got every chance that this does move lower, Ali. And if it's the US data that takes it there, you want to make sure it's under 60.50 and staying under 60.50. Otherwise, there may be a possibility of a bounce there. But you're on the right side, so as long as you're slicing and dicing, that's pretty good. Right, guys and girls, you've got anything else? Chuck it up for me. Let's have a look what else I can chew over. Dollar CAD, I'll have a quick look at that. Not really much to say about this one. It's holding up pretty well. This 137.35 level is my important level. This was the level that I said if we have this move here, if it's going to pull back, it needs to keep above that. Had a little mooch under, but we're still back above it. So for now, 137.30.35 is your important level here. We're just finding a bit of support coming in ahead of that. So it looks like a bit of protection ahead of that level. Keep that going, then there's every chance we have a mooch up to these high 138s. Again, this is a level I've been looking at maybe to tap a scalp off of if we get a strong move up there, and that might get us close if we get some strong data. But if we do get another move up here, it will look pretty strong because it will mean this is being maintained and we're not ready to have a steeper pullback, which means we could be on for 138s, the higher 138s, 139s. And then we get to see whether we're going to put in a test of these range highs that we've had up here in high 138s, 139s, just sub of that 140 level as well. A lot of eyeballs on that. But it's still looking strong. So, when we look at Bitcoin, mate, I'm too sick to look at Bitcoin. Let's have a look at Bitcoin. So it's obviously looking positive, but it's still just maintaining this channel down. Okay, so it's a long running thing. Okay, it's been running all year. We need to get above there. Excuse me. 60, the highest 69s, probably call it 70,000. If we're getting back above there, then we're going to test some of these levels and maybe even have a look at the highs. But if we don't, if we get up to here, a bit like what we had here with a little double top, let's just zoom that in a little bit. If we get another hold up here, then there's every reason to suggest that we may get a bit of a pullback, steep one, maybe even go and test the bottom of the range. So it's a bit of context needed of this one. Obviously, it's bullish on the month, been bullish for a couple of months, but it's still in a longer term downtrend. So until that starts breaking, you should or might expect that to continue. What are you doing in it again, mate? Just let us know. I can't recall. I do apologise. Give me one moment. Sorry about that. Another little coughing fit. I'm going to call it a day, folks. I don't want to keep waffling on when I'm not making sense to myself, let alone anyone else. yeah, you've traded that channel. Okay, 69.50. Yeah, that looks 69.5. Yeah, that looks reasonable. That's somewhere you've got to potentially think about taking profit. At least take some off the table when you get there to your level. Because if it does hold there, then you don't want to not have taken any profit to see it, pull back to 60k or something. So, my thoughts, I'll explain that to you when we was talking about gold. If you're in a winning trade, don't give it up, but don't forget to take some profit on the way. Right, that's it for the day. Take care over the ECB, over the US data. You'll catch us on the Face show later. We'll be covering the decision live, so tune in for that one. Have a good day, everybody. See you tomorrow. Cheers, Patrick. Cheers, Brad.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.